Okay, let's unpack this. Imagine you're, suddenly managing the finances for a loved one's estate. Or maybe you're setting up a trust. It's a huge responsibility, right? Lots of questions. And then, bam, this form pops up you might never even heard of. Form
Mm.
141. What is it? Why is it so important? Today, we're doing a deep dive into U.S. income tax returns for estates and trusts. Specifically, Form 1041 and its schedules for 2024. Our mission to cut through all that dense IRS talk. Make it clear, give you actionable insights. We want you to understand the purpose, who's involved, the key filing stuff without, making your head spin. Think of it as your shortcut to getting informed fast. That's some surprising facts, maybe a few warnings too. And for this deep dive, we're going straight to the source. The 2024 instructions for Form 1041 right from the IRS, the definitive guide. We're going to translate it for you. So let's start right at the beginning. What is Form 1041 really at its core? We know it's a federal tax return for states, trusts, bankruptcy estates. They use it to report income, deductions, all that. But what's the bigger picture? Is it just another tax form?
Well, what's fascinating, I think, is that you have to see a trust or an estate as its own taxpayer, for a time anyway. It's a separate legal entity for federal tax purposes. But here's the key insight, the surprising part maybe. It's often called a pass-through entity. Think of it like a temporary holding account for income. The income comes in, but a lot of it often just passes through to the beneficiaries. And they are the ones who end up paying the income tax on those distributions on their own returns. Form 1041. That's the tool to figure out how much passes through. And then Schedule K1, that's the note that tells each beneficiary, hey, here's what you need to report.
Ah, okay. That pass-through idea, the holding account analogy, that really helps. So it's not always the trust or estate paying the tax itself. So if this thing is its own taxpayer who's actually, required to file Form 1041, is there a specific trigger? What's the main thing people need to look out for?
The most common trigger, and honestly, often the first surprise for a lot of people, is how low the income threshold is. For most regular domestic estates and trusts, if they have gross income of $600 or more in a tax year, they have to file Form 1041.
$600. Just $600.
That's it, 600. Think about that. That could just be, a little bit of interest from a bank account. So, yeah, a lot of seemingly small estates or trusts easily hit that mark. There are other triggers, like having a non-resident alien beneficiary. That's less common, but just as important. And bankruptcy estates, they use 1041 too, but their threshold for 2024 is way higher, $14,600 in gross income.
Wow, that $600 really does sound like it could catch people off guard. Definitely a heads up there. It shows how fast you can fall under these federal filing rules. So, who are the actual people involved? The ones doing the paperwork, making the decisions?
Okay, so the main person is the fiduciary. If you're filing Form 1041, that's probably you. It's a broad term could be a trustee for a trust or an executor, administrator, personal representative for an estate. You're the one legally on the hook,
Hmm.
gathering assets, paying debts, distributing what's left
Yeah.
correctly. And then on the other side, you have the beneficiaries, the heirs, the people actually receiving money or property from the estate or trust. And importantly, what you do as the fiduciary directly impacts their taxes. So it's a really critical role.
Okay, now here's where I think it gets really interesting. Because not all these estates and trusts are the same in the eyes of the IRS, are they? There are different types, different rules. Some have special tax calculations. Some don't even use Form 141 at all. It sounds like figuring out exactly what kind of entity you're managing is like step one, a crucial first step.
Absolutely. That's foundational. Understanding the entity type is key, and frankly, it's an area where fiduciaries can easily get tripped up. For instance, take a decedent's estate. It usually forms right at death.
Yeah.
And the fiduciary, they actually get a choice for the tax year. They can pick a fiscal year, 12 months or less, ending whenever they choose.
Yeah.
But compare that to most trusts. They generally have to use a calendar year. No choice.
Huh. It seems like a small detail, but I can see how that tax year difference could impact planning.
Exactly. It affects timing for income, deductions, distributions.
Mm-hmm.
It matters.
So beyond the tax year thing, what are some of the main types of entities we see with Form 1041? What makes them different tax-wise?
Okay, let's hit the big categories. First, you've got simple trusts. These are pretty restrictive. They must distribute all their income currently every year. They can't hold anything back for charity, and they can't distribute the principal of the corpus. Because they distribute everything, they get a slightly higher personal exemption, $300 for 2024. Then there are complex trusts. Basically, if a trust doesn't meet all those simple trust rules, it's complex. And most trusts fall into this category. They might accumulate income, or make charitable contributions, or distribute principal. Their exemption is lower, just $100. The key insight is really about control over income and distributions. That's what separates simple from complex and affects the tax outcome.
Got it. Simple means everything out. Complex means more flexibility. And then there are grantor-type trusts. These always sound a bit mysterious. I've heard sometimes they're kind of ignored for tax purposes. What's the deal there?
Yeah, that's one of the most surprising and often beneficial types, a grantor trust. For income tax, the trust itself is often treated as, well, transparent,
Yeah.
ignored, basically. All the income, deductions, credits, they're treated as belonging directly to the grantor, the person who set up the trust.
So the trust doesn't pay the tax?
Nope, it flows directly onto the grantor's personal tax return, their Form 1040. Which means, as the fiduciary, you typically don't issue a Schedule K-1 to the grantor for that income. Instead, you usually attach a statement to Form 1041, just detailing what the grantor needs to report on their own return. It's a very different flow.
And I saw something about optional filing methods for these grantor trusts. That sounds like it could be a big time saver.
It definitely can be. For certain types of grantor trusts, the IRS says, look, you don't have to file full Form 1041. There are simpler options, like Optional Method 1. The trustee can just give the grantor's name and Social Security number, their TIN, directly to the banks or brokers paying income to the trust. Then the grantor just reports everything directly on their 1040. No 1041 needed from the trust side, potentially. It can seriously cut down the paperwork, especially if the trust doesn't even have its own EIN number. It shows how knowing the specific rules can really help.
That's a great practical tip. Are there other specific kinds of trusts or estates with unique rules we should flag?
Yeah, a couple more are worth mentioning. Qualified revocable trusts, or QRTs. These are trusts the person could take back, revoke before they died. There's a valuable election here, a Section 645 election. It lets the QRT choose to be treated as part of the estate for income tax purposes. So you file one combined Form 1041 under the estate's name and EIN. Simplifies things. But here's a detail people often miss. All QRTs, even if you make this election, have to get a new EIN after the grantor dies. Can't keep using the old one.
Ah, okay. Good administrative point. What else?
Then you have electing small business trusts, ESPTs. These let trusts hold S corporation stock, which normally isn't allowed. But here's the kicker. The S corp portion of that ESPT, it's taxed totally separately at the highest individual rate, 37% for 2024, flat rate.
Wow, 37% regardless of the income level.
Regardless. And that part of the trust doesn't get an income distribution deduction, doesn't get an exemption. It's very specialized, very complex tax treatment. And one more quick one. Qualified disability trusts. For 2024, these get a much higher exemption, up to $5,000, and it doesn't get phased out. A nice benefit there.
It's really clear that figuring out the type of entity is absolutely critical. But what about those that don't use 1041? Knowing what not to file seems just as vital.
Exactly right. Filing the wrong form is, well, it creates its own set of problems. You need to know the exceptions. For example, Alaska Native Settlement Trusts, they use Form 1041-N. Charitable Remainder Trusts file Form 5227. Qualified Funeral Trusts use Form 1041-QFT. Even some bank-managed common trust funds might use Form 1065, the partnership return. So, yeah, Form 1041 covers a lot, but it's definitely not one-size-fits-all for fiduciaries. Always double-check the specific form needed for your situation.
Okay, so once we've nailed down the entity type, we get down to the actual numbers, income, deductions. What are the critical things fiduciaries really need to zero in on when they're filling out Form 1041?
Well, on the income side, it looks pretty similar to what individuals report,
Yeah.
interest, dividends, capital gains, business income, rental income. But there's a unique category called income in respect of a decedent, or IRD. This is income the person had earned but hadn't actually received before they died, like maybe unpaid salary or an IRA distribution they hadn't taken yet. That IRD gets reported on the estate's Form 1041. And here's a really critical point about capital gains. For 2024, estates and trusts hit the highest capital gains tax rates, 15% and 20%, at much, much lower income levels than individuals do.
Lower levels. How much lower?
Significantly. For 2024, the 20% rate kicks in for income over just $15,450.
15,000. Wow.
Yeah. So if the estate or trust has significant capital assets it needs to sell, you really need to plan carefully. Selling too much in one year could trigger a surprisingly high tax bill. Proactive planning is key there.
That's a huge takeaway, hitting those top rates so quickly. Yikes. Okay, but deductions. That's often where the strategy comes in, right? And maybe the potential mistakes too. Let's talk about things like fiduciary fees, administrative costs. The rules there seem a bit tricky.
They can be. The IRS draws a pretty specific line. The basic idea is, if it's a cost that an individual owner wouldn't normally incur just owning property, then it's more likely deductible for the trust or estate. So think about appraisal fees. If you need an appraisal specifically for the estate tax return or for making distributions, deductible. But an appraisal just for, say, insurance purposes, probably not deductible on Form 10 and 41. Investment advisor fees get complicated too. You can generally only deduct the incremental costs the extra fees charge because it's a trust or estate beyond what an individual would pay. And a common trap, bundled fees, where you get one bill for lots of different services, legal, accounting, investment management. You often have to carefully allocate that fee between the deductible parts, like tax prep, and the non-deductible parts, like basic investment advice. Getting that allocation right is crucial.
Okay, that distinction, what's special to being a fiduciary versus what anyone would pay, that's a helpful way to frame it. What other big deductions should fiduciaries have on their radar?
Another really important one is the charitable deduction. On Schedule A estates and some trusts can deduct amounts paid or even permanently set aside for charity. And what's interesting here, a neat planning tool, is that fiduciaries can elect to treat contributions made in the following tax year as if they were paid in the current year. Gives you some flexibility.
Well, that's handy.
Yeah. But maybe the most central deduction is the income distribution deduction, or IDD, on Schedule B. This is the heart of that pass-through idea we talked about. It's the deduction the estate or trust gets for the income it distributes or is required to distribute to the beneficiaries. This is what reduces the entity's own taxable income. There's also an estate tax deduction related to that IRD income, basically to prevent double taxation if estate tax was already paid on it. And the qualified business income QBI deduction, while the beneficiaries actually calculate and take the deduction on their returns, the trust or estate has the job of providing all the necessary QBI info to the beneficiaries. That usually goes on a statement attached to their Schedule K-1.
Okay, so with all these moving parts, income types, tricky deductions, those compressed tax brackets, what's the bottom line for fiduciaries trying to stay out of trouble with the IRS?
Honestly, it really boils down to meticulous record keeping and hitting deadlines, paying attention. Generally, if the estate or trust is looking at owing $1,000 or more in tax, they need to pay estimated taxes throughout the year, just like individuals. But here's a really helpful exception. An estate doesn't have to pay estimated tax for its first 2 tax years after the decedent's death.
Oh, that's a nice grace period.
It is a welcome relief during a tough time. But after that, or for trusts generally, you got to pay attention to estimates because the penalties, they're stiff. Late filing can be up to 25% of the tax due, and there's a minimum penalty now, $510 if you're more than 60 days late. Late payment penalties, underpayment of estimated tax penalties, they add up. Even just failing to put a beneficiary's correct taxpayer ID number, their TIN, on the Schedule K-1, that can trigger a $50 penalty per failure. It shows they take this reporting seriously.
Right. And wasn't there another layer of tax we should mention? The net investment income tax.
Yes, good point. The NIIT. Estates and trusts can get hit with this too. It's an extra 3.8% tax. It applies to their undistributed net investment income if their adjusted gross income, their AGI, goes over a certain threshold. For 2024, that threshold is pretty low for estates and trusts, $15,200.
$15,200. That seems really low.
It is. Much lower than for individuals. For bankruptcy estates, it's higher, $125,000. But for regular trusts and estates, yeah, $15,200 AGI. So if a trust is holding on to investment income instead of distributing it, it could easily trigger this extra 3.8% tax on top of its regular income tax. Another reason why distribution planning is so important.
Okay. Beyond the pure tax calculations, the instructions themselves sometimes have these, well, unexpected bits of information or important warnings. I think I even saw something about missing children in there, which seems out of place on a tax form.
Yeah, it does, doesn't it? But yeah, the IRS actually partners with the National Center for Missing and Exploited Children. You'll see photos of missing children on some pages of the official IRS instructions. It's, sobering reminder, but also kind of humanizing that even these dense documents can serve a wider purpose. On a more practical note, modernization of the IRS is really pushing e-filing for Form 10.1 now. They have forms like Form 879F for electronic signature authorization, making it easier for fiduciaries and preparers to file electronically. That process seems to be getting smoother.
Good to know they're making some things easier. But on the flip side, the instructions also seem to have some pretty strong warnings, especially about so-called abusive trust arrangements.
They do, and it's a critical warning for anyone listening who might be tempted by schemes promising impossible tax savings. The IRS is very clear. Arrangements that claim to eliminate or drastically cut your federal taxes without you actually giving up control over your assets or income, they don't work. They state pretty bluntly that these benefits are inconsistent with tax law. And they warn that participants and the people promoting these schemes can face really serious penalties, civil and potentially criminal. It's a very direct, don't do it message.
Yeah, definitely sounds like something to steer clear of if it sounds too good to be true. So, for fiduciaries trying to do things the right way, navigating all this complexity, where can they turn for reliable help, official help?
Okay, a few key resources. First, there's the Taxpayer Advocate Service, TAS. It's an independent organization inside the IRS. Their whole job is to help taxpayers solve problems they can't resolve through normal channels, protect taxpayer rights, and even suggest changes to the system. Their tagline is literally, your voice at the IRS. You can find local advocates, or there's a toll-free number, 877-777-4778. And of course, irs.gov, that's always the primary source. You can get forms, publications, search answers to tax questions, get the latest updates. It's really comprehensive.
Okay, good resources. And speaking of updates, just to recap for everyone listening, what were those main what's new items for the 2024 Form 141 instructions we should highlight one last time?
Right, the key takeaways for 2024 specifically. First, the filing deadline for calendar year states and trusts is April 15, 2025. Second, those capital gains rates we talked about, they're adjusted for 2024. And remember, estates and trusts hit the higher 15% and 20% rates at very low income thresholds. That's probably the biggest planning point. Third, the filing threshold for bankruptcy estates increased to $14,600 gross income. And fourth, the exemption for qualified disability trusts went up to $5,000. Those are the main changes to keep front of mind for 2024 returns.
Okay. We've really covered a lot of ground here on Form 1041, from the basics like who files and that low $600 threshold, to all the different types of entities, the crucial differences between them, the details of income and deductions, those tricky capital gains rates, and the key updates for 2024. This deep dive definitely shows just how complex managing an estate or trust can be, especially the tax side.
Absolutely. To kind of boil it down, Form 1041 isn't just another form. It's really the central hub for the financial life, tax-wise, of an estate or trust. Getting the entity type right, simple, complex, grantor or estate, whatever it is, it's step one because it drives everything else, the rules, the exemptions, the rates. And then it's about correctly tracking the income, being smart about deductions like those fiduciary fees, and managing the distributions to beneficiaries properly. That's what determines who pays tax on what, and it's what keeps both the fiduciary and the beneficiary safe from errors and penalties.
So it really sounds like if you're stepping into that fiduciary role, you're not just managing money. You're managing this whole intricate web of legal and financial rules. And every decision seems to have a ripple effect, tax-wise, for potentially multiple people. It kind of makes you wonder, beyond all the numbers in the IRS rules, how does the unique story behind each estate or trust, the human relationships involved, how does that actually shape the fiduciary's experience navigating this whole tax maze? Given all this detail, all the potential pitfalls, it really seems like getting professional help here is often money well spent. We definitely encourage you to talk with a qualified tax professional for advice specific to your situation.